There is a running joke in the trading community: the exact millisecond you finally decide to buy a coin or a stock, the market immediately reverses and crashes. And the exact second you lose patience, enter panic mode, and hit sell, the price aggressively skyrockets. It feels deeply personal. It feels like someone is watching your screen, tracking your exact account size, and playing a cruel joke on you. But it isn't a joke. And it isn't bad luck. It is the core architectural design of the modern financial system. Whether you are day trading tech stocks on Wall Street or swapping highly volatile altcoins in the crypto market, you are not participating in a fair, decentralized game of supply and demand. You are stepping into a ruthlessly engineered hunting ground where retail investors are not the customers, they are the fuel. They are the prey. Today, we are going to break down the cold, calculated mechanics of smart money, how institutions and crypto whales manipulate charts to hunt your money, and why everything you've been taught about technical analysis is exactly why you keep losing. To survive in this game, you have to stop looking at charts as lines of geometry and start looking at them as maps of human anxiety. And it all begins with understanding a single, critical concept that the financial industry rarely explains to beginners: liquidity. Most retail traders think buying and selling an asset is instantaneous. You log into your app, you press a button, and boom, you own the stock or the crypto. This works for you because your account size is small. If you want to buy $1,000 worth of Bitcoin, there is always someone willing to sell it to you at the current price. But major hedge funds, institutional market makers, and crypto whales operate in an entirely different reality. They move with tens of millions, sometimes billions of dollars. Because their positions are so colossally massive, they cannot simply press a button and buy or sell at the current market price. If a crypto whale tries to dump $50 million worth of a token all at once into an average market, they will instantly exhaust all available buy orders. The price will flash crash violently, and the whale will end up selling the majority of their tokens at a massive loss. This is what the industry calls slippage. Therefore, the game changes completely for the 1%. For a giant player to sell a massive position without crashing the market, they need a massive, highly concentrated wave of buyers. For a giant player to buy a massive position without driving the price through the roof, they need a massive wave of panic sellers. They need liquidity. And they find it by exploiting your emotions and your retail technical analysis. This is where the concept of stop-loss hunting comes into play. Think about how the average retail investor learns how to trade. You watch a few tutorials, read a textbook, and learn the basics of support and resistance. Everyone looks at the exact same charts, the exact same moving averages, and the exact same indicators. Imagine Bitcoin or a popular stock hits a very clear support floor 3 times. To a retail trader, this looks like a perfect, high probability buy setup. Millions of retail traders place their buy orders exactly at that support line. And right below that line, they all place their stop-loss orders to protect their capital. To a retail trader, that stop-loss is a safety net. To an institutional algorithm, that area right below the support line is a gold mine. It is a highly concentrated ocean of guaranteed sell orders waiting to be triggered. So, what does the smart money do? They deliberately use their capital to push the price down, forcing it to break the support level. To the retail trader looking at the chart, it looks like a catastrophic breakdown. Panic sets in. Your stop-loss triggers, which automatically turns your position into a market sell order. Millions of other retail traders panic sell manually because they think the market is officially dying. But look at what happens next on the chart. The exact moment all that retail panic selling is triggered, the whale's massive buy orders are sitting right there to absorb it. The whale gets to buy millions of dollars worth of the asset at an absolute discount, using your panic as their entry door. Within minutes, the selling pressure vanishes, the price aggressively reverses, and it shoots upward, leaving the retail traders empty-handed, deeply confused, and locked out of the move. You didn't read the chart wrong. You were simply harvested for liquidity. In the crypto market, this predatory architecture is magnified by 1,000% due to the prevalence of leverage and derivatives exchanges. Because crypto markets are highly unregulated compared to traditional equities, exchanges and market makers have access to order flow data that shows the exact liquidation prices of over-leveraged accounts. If the funding rates show that the market is heavily skewed toward retail traders betting that a coin will go up, the smart money has a massive financial incentive to trigger what is called a long squeeze. They artificially dump the price just enough to hit the liquidation threshold of the highest leveraged traders. This triggers an automatic chain reaction of forced liquidations that act as market sell orders, which drives the price down even faster, wiping out billions of dollars of retail wealth in seconds. The whales absorb the liquidations at the absolute bottom, and the market recovers as if nothing ever happened. So, how do you protect your capital from being hunted by algorithms that are smarter, faster, and wealthier than you? You have to stop thinking like a retail chartist and start thinking like a liquidity provider. First, you must accept that the most obvious technical setups are almost always traps. If a support level, a resistance level, or a chart pattern looks too perfect, do not place your orders exactly where the textbook tells you to. Anticipate the fake out. Professional traders do not buy the support, they wait for the support to break, they wait for the stop-loss hunt to happen first, and they only enter the market once the weak retail hands have been completely flushed out of the system. Second, you must eliminate the exact tool that the smart money uses to force you out of your position, forced liquidation. If you are trading crypto or high-growth stocks with high leverage, you are willingly stepping into a rigged casino where the house can see your cards. The only way to neutralize a whale's manipulation is to remove the time and price pressure from your trade. By holding spot assets or using incredibly low, non-threatening position sizes with wide breathing room, a 10% or 20% flash crash ceases to be a catastrophic account deletion. Instead, it simply becomes a temporary dip. The 1% does not beat retail investors because they are inherently better at predicting the future. They beat them because they thoroughly understand market structure, order flow, and the predictable psychology of human panic. If you treat the market like a video game to get an instant hit of dopamine, the market will eventually locate your stop-loss and take everything you have. But when you align your strategy with where the smart money needs to find liquidity, rather than where the crowd is panicking, you stop being the bait. You finally become the hunter. If you want to keep uncovering the cold, calculated truth about wealth, systems, and investor psychology, make sure to subscribe. I'll see you in the next episode.